And in some cases, you're even getting a cable TV as part of your association fee as well. When looking at a condo, you'll want to be careful to make sure you review their financial records and review whether or not they have something called reserves. Reserves are when the condo is collecting those monthly fees from their tenants. They're putting some of that money in the bank and saving it, and they're spending some of that money for ongoing expenses and ongoing operations. Reserve means that they've saved a significant amount of money for unforeseen things like an elevator breaking or the pool requiring major maintenance or things of that nature. If a building has good amount of reserves, that means they're typically in good financial condition, and that's a better case than if you go into a building that doesn't have any financial reserves or is working in the red or in a deficit kind of condition. So look out for that in their financial statements. You'll also want to make sure you look at major ticket items like roofs, pools, elevators, and things of that nature when you're looking at condos, because that may be something of a surprise if once you buy and then the building association decides that it's time to update or replace these items. That could be some high costs, and that could result in a special assessment. A special assessment is over and above that monthly association fee, and it could result in a temporary increase in the association fee, or it could result in a special separate payment you'd have to make in order to pay for the special assessment. So in other words, if the building needs a new elevator and it's going to cost, say, $100,000, they're going to divide that up by each unit in the building, and then they're going to ask you to pay for that. And they're probably going to ask you to pay for that over the span of a year or two and not all at once. So it's not going to be that big of an increase, but it would be something to factor in. Same thing for roofs and other big ticket items. The other thing to look out for condos is if they don't have cash reserves, the bank may ask you to pay 25% as a down payment rather than a typical 20% that would be the down payment for a first-time buyer. If you choose to go for a single-family home, again, you'll have more room to spread out. You'll have a yard, room for the dog, but you will be responsible, again, for everything that goes wrong inside and out. And there is no association relating to that. If you need a new roof, you'll have to buy a new roof. If you need new plumbing, you'll have to buy new plumbing, and so on and so forth. Typically for single-family homes, the roof is the most expensive thing to have to fix or replace. So look out for the remaining life of the roof that your next home is going to have, because that's going to give you an idea of maybe a large expense that's coming, and also might give you some negotiation room when it comes time to negotiate on the price of the home. So the bottom line is when you're buying a home, you need to factor in several costs, and those are going to be your mortgage, insurance, any HOA or association fees, and if it's a single family home, that you're gonna have utilities, and ongoing maintenance, and taxes. You're going to want to estimate these things to make sure you can afford to do this for either condo or a single family home. Your insurance is going to be based on the value of your home, and it's going to be depending on what type of home it is and where it's located. If you have a condo, insurance is going to be much, much less than if you have a single family home. If you have a single family home in an area that is prone to natural disasters or large storms, then your insurance is likely going to be a lot higher than where these do not occur as frequently. Taxes are going to be based on your municipality. This is what your municipality charges for basic services like fire and transportation and the police department and so on and so forth. In some states where there is no state income tax, the property tax is typically higher. And these property taxes can be anywhere from just under 1% to 2 to 3% or higher, depending on the location. As an example, in Florida, it's upwards of 2% for your property tax because Florida does not have a state income tax. So once you've decided on the type of place that you want to go after, you're going to want to understand the whole process for buying a home. There is a whole process that starts from working with a real estate agent typically, all the way through to inspections, closing, and then finally moving in. So let's go through that in detail. When buying a home, you can choose to look online and try to work on your own with the seller. But in many markets, there's a kind of a distrust between buyers and sellers, and that's where real estate agents come in. The important thing to know is that as the buyer, real estate agents really are no cost to you. The real estate agent fees for both the agent of the buyer and the agent of the seller come from the sale of the home. So the seller is the one that's actually paying the real estate agents. So you as the buyer can take advantage of the real estate agent's services and expertise without really having to worry about paying them for their services. The real estate agent will have the latest information on what homes are available for sale and what has sold recently and for what price. So you'll be well informed as to what the going market rate is for the home that you're looking for. And having this good understanding of the market will give you a better idea of what price to offer for the home once you decide to go ahead and make an offer. Before starting your search with an agent though, you'll want to make sure you get pre-qualified with a lender for the amount of money that you think you're going to need for the loan of the home. You're going to want to do a rough calculation of what you think you can afford, and there's several calculators online to help you do that. And once you decide that, you're going to then determine, okay, I can afford this based on my current salary or the current household income. And that will mean that I'm going to be putting this amount of money down. Therefore, I'm going to have this amount of money that I'm going to need to go borrow. And let's say we stick to the $160,000 that we mentioned earlier, because you're going to buy something that's $200,000. Then you're going to want to go out and get pre-qualified for that $160,000 loan from a bank or credit union. You can choose to work with your own bank or credit union if you have good credit, and you can shop around online. Sometimes you can get good interest rates from online lenders like Quicken Loans or folks like that. Or if you don't have the best credit and you're finding it difficult to find something on your own, you might want to work through a mortgage broker. And these are folks who work with buyers in order to line them up with lending institutions that will lend them the money to buy the home. When you work with a mortgage broker, your fees are likely to be a little bit higher because the mortgage broker is going to be making some money off that deal because that's how they make a living. And your interest rate may be a little bit higher, but it may be the best opportunity for you to get the lowest rate you can in your particular situation. What I would do is, if I had good credit, I would try to go on my own and search for the best rate I can amongst banks and credit unions. And if I thought I could get a better rate through a mortgage broker, then I would work with a mortgage broker. The idea here is to look for the best interest rate you can find for the loan that you're looking for that fits your credit score. If you happen to be a veteran of the military or work for some other government organizations, you may qualify for veteran administration loans or other loans that are specially made for folks in those categories. And in many cases, those loans may be a little bit lower interest rate, which is great, and they may allow you to pay a lower down payment, which is nice. So look around for special loan rates and special loan deals for the particular groups or institutions that you might belong to. First-time home buyers will get tax breaks as well. So make sure you take advantage of those when filing your income taxes for the year after you buy your first home. In any case, when applying for a loan, the lender will ask you for recent pay stubs, tax returns, and all of your credit card and other debts in order to figure out your debt-to-income ratio and whether or not you are a good risk for them as far as a lendee. The lender will also pull your credit report, so make sure your credit is at the best level it can be before you start the application. The better your credit and the lower your debt, the better the interest rate you'll get. And if you have great credit and a low debt ratio, you'll have a much better chance of obtaining the loan in the first place. See my video on establishing good credit in order to see how to build credit and how to get to and keep a great credit score. Once you've been pre-qualified for the loan with the bank, you want to tell the real estate agent what parameters you're looking for with your home. And these are things like number of bedrooms, number of bathrooms, whether it's a standalone single-family home, a townhouse, or a condo. The agent will also ask you about price range, and be open here and just say exactly what the price range you're looking for. A lot of people, when they first start out on that process, will kind of lowball the agent, and then the agent will come back with some options that are not great. They're not in great neighborhoods, or they're not what they were looking for, and that will reset expectations. And that's okay if you go through that process. It's a learning process. You might start off saying, well, I'd like to buy something for $200,000, and I'd like it to be in this neighborhood and have these parameters. And your agent may come back and say, well, for $200,000, there's really nothing in that particular neighborhood. You would have to go to these other neighborhoods here, and then you'd have to make a choice whether to go for the lesser neighborhoods or to increase your budget. That's really up to you. Once you have a realistic set of parameters that the agent can work with, they will then find all the candidate homes that are for sale in the areas that you're interested in and send you updates via email. And as new homes come up for sale that fit your criteria, you'll be automatically forwarded those for you to review. And this process can take, a few days to a few weeks as you're reviewing existing and new properties that come on the market that fit your criteria. If you have lots and lots of these to review, it's great to review them online first. Through the emails that your realtor sends you, you'll see pictures of the properties and you'll get a lot of information about each of those. And you can then narrow them down to the few that you're going to want to go to visit. You may not want to see 100 homes, but you might want to see more like 15 to 20, or in some cases, depending on the market, it may be more like 5 because it's a very hot market and properties are being snapped up very, very quickly. In any case, you're going to do that first review through an online process and then narrow down to the places you'll want to visit. And your realtor will take you to those and walk you through each of the homes and show you what's available. And you can keep doing this until you find a property that you're actually interested in and you want to put an offer on. Once you've selected this property, then you move on to the next stage. And this is where you work with your agent to drop a contract for the purchase of the home. Home purchase contracts these days are pretty straightforward, and realtors are trained to create them from standard templates. But you can choose to modify those in different ways. And you can choose to have your personal lawyer look at the contract to make sure that it meets your needs and has the modifications that you want it to have. The main part of the process at this stage is to figure out the offer amount. Remember, when a house goes up for sale, it's offered at a price, but you can decide to offer a price that is different than the asking price. The asking price is merely a starting point. In some real estate markets where the house may have been sitting on the market for a long time and there may not have been any other sales for a long time and these markets are kind of soft, you may decide to offer under the asking price in order to try to get a better deal. But lately, this hasn't been happening, of course. Lately, we've been in hot real estate markets where in many cases, buyers are having to offer above asking in order to even be considered in a competitive bidding process. And here's where your realtor can help you figure out what the best price will be for you to be able to buy that home that you're interested in. They're going to typically know what the right price range is for the particular home based on comparable sales and how the market has been going. Once you decide on the offer price, this will of course determine the down payment. And as I mentioned before, this is typically 20% of the price of the property. And that down payment will be due at closing. A portion of that down payment will also be due a few days after the signing of the contract, and this is called the earnest money deposit. This is a deposit that shows that you're definitely serious about buying the home and you're not just a looky-loo. Once you have that earnest deposit in, the bank and the seller will have a good feeling that you're going to go all the way through to closing and the commitment to buying the home. If your down payment is less than 20%, then your offer is not going to be as good as somebody who is paying 20%, so be aware of that. And your bank may ask you to buy something called private mortgage insurance, or PMI, for down payments of less than 20%. This would be an additional monthly payment that you have to pay, which is basically an insurance that the bank has that will make the bank whole should you default on the loan. The offer typically includes a short time period when you will be able to inspect the home. And this is a very important part of the whole process. You should always inspect the home prior to committing to purchasing it. This will allow you to determine if there are any major issues that either you or the seller doesn't know about that will be required to be fixed either prior to or after you buy the home. Never commit to buying a home before having it professionally inspected. Before sending your offer to buy the home, make sure you understand the contract and agree with everything in it. This is a legal document that you are signing, and so make sure that you understand what's in there and that you're willing to follow through on all of those clauses. If needed, have your attorney review the contract prior to you sending it to the seller. Remember that these videos are for informational purposes only, and you should definitely have a professional review all documents associated with the home purchase before committing to the contract. Also, not all offers are accepted, so you'll want to have other choices to fall back on. If your offer is not accepted, your agent can ask the seller's agent to keep your offer as a backup offer in case the offer they did accept falls through. If your offer is accepted, then you will be asked to pay your earnest money deposit. This could be 10% of the price or $10,000 or $5,000, whatever it is that you had entered into the contract. Again, the higher the earnest money deposit, the better chances of winning the bid versus other bidders that might be putting down less money or putting a lower earnest money deposit. You should know that earnest money deposits and down payments are held in escrow in a separate account that is not accessed by the buyer until after closing. These are typically controlled by a title company, that is a legal entity that's typically run by lawyers that keep these monies separate and in non-interest bearing accounts until it is time to disperse the funds at closing. The title company will be typically selected by your realtor, and they'll be the ones that distribute the monies at closing. Once you've agreed on a price and signed the contract, the next thing will be the inspection. Now, you'll want to try to get the inspection done in a short amount of time after the signatures of the contract, and ideally before sending the earnest money deposit, because if your inspector finds something that is unacceptable to you and that the seller is not willing to remedy, you can then back out of the contract based on that situation. So if you do the inspection prior to the earnest money deposit date, you don't have to then worry about getting your deposit back. Now, if you back out of the contract because of something that was found in the inspection and you've already paid your earnest money deposit, there's nothing to worry about there. You can always back out based on an inspection finding, but it will take a few days, maybe a week or two, for you to get your earnest money deposit back. So it's cleaner to do the inspection first and then to send the earnest money deposit. The inspector will provide an inspection report that includes all of the costs needed for all of the issues that he found that need to be repaired. Now, in some cases, these are going to be minor cosmetic things. Those are things that you shouldn't worry too much about, but pay close attention to major items like appliances, roofs, pools, pool heaters, and foundation cracks or things of that nature. Electrical panel work, things like that. Those kinds of things are going to be the high-ticket items, and those are the things that you're going to want to make sure you understand what you're getting into when you're buying this home. If the inspector does find some major issues, you're going to have the decision to make of either backing out because you're not interested in a home that has these major issues, or you're going to potentially want to ask the seller for a reduction in price or for a credit in the amount of the repair at closing, so that then you can cover those repairs based on the reduction on the price of the home. Now, in some hot real estate markets, you may not be able to get any of these concessions because the seller has all of the power. There could always be another buyer that comes along that doesn't care about major repairs, has deeper pockets, and is going to go ahead and repair these things anyway because they feel like they can turn around and sell the house for a higher price once they've made those repairs. And you may decide to take on the risk of those repairs anyway in a hot market because you really like the home or the location, but you're still going to want to understand what you're getting into, and that's why the inspection report is so important. You should also keep in mind that the inspection report will probably have the worst case cost for the repair items. You're going to want to work with your realtor and other folks who have more experience with repairs to understand what the real costs of those might be. So for example, if the inspector says, oh, this home is going to need a new roof in the next 2 years and the roof is going to cost $50,000, you might talk to friends or family that have recently repaired roofs of similar size, and they might tell you, well, it's going to be more like $20,000. And you understand that the inspector is giving you a worst case scenario there. So as I said, once you've reviewed the inspection report, you can decide to either go with the home as is because the inspection report didn't find anything major. If it did find something major, you can ask the seller for a concession, either a reduction in the price of the home, or more typically a credit at closing for the amount of the repairs. Or you can decide just to back away and go on to find another home. If you do go ahead and agree to move forward after the inspection, then you will send in your earnest money deposit if you haven't already done so. And then the realtor and title company will work with the bank to go on to the next steps in the process. In the next few weeks, the bank and the title company will work together to establish a closing date, and the bank will do some final checks on your income, your debt, and your credit. During this period, it's important not to open new credit accounts. Don't open new credit cards. Don't go buy a car. Don't do anything to change your credit during this period because you're going to want to make sure you maintain the highest credit you can during that amount of time. Your bank will essentially be working towards something called a commitment letter, which is the thing that says, yes, they are committing to lending you the money that you've asked for, and they've decided that you're a good enough credit risk to warrant that loan. They will also target a closing date, which will be on or about the closing date that was estimated on your contract. During this time, your contract may have to be amended, and that happens all the time, so don't worry about that. And that may happen because the closing date may have to be moved out, for example, because of a holiday or because the bank wasn't able to finish all of their research on time, so you may have to extend the contract by a week or two. Once everything is in place and the date of the closing comes, you will come to the offices of the title company and sign a bunch of documents. The most important ones will be the ones the bank has drawn up. That will be the mortgage. And in that case, you're signing a commitment to pay the bank that monthly fee for the duration of the loan. And you're saying you're going to hold up to that end of the bargain. And in return, the bank will fund the account with the loan amount. Typically, the title company will obtain signatures from the buyer and seller separately. The day before the closing, of course, you will have to send in your down payment via wire transfer. the title company will provide you with the wire transfer information. And in the case of a $200,000 home with a $40,000 down payment, and let's say you had a $10,000 deposit, you'd be, of course, wiring $30,000 into that account the day prior to closing. The mortgage documents that you sign, of course, say that the bank technically owns the home and you are borrowing money from them in order to pay them off on that mortgage note. The documents will also say that if you default on those payments, they may decide to foreclose on you and take the home back and sell it to someone else in order to make up for their loan amount. Once the funding is complete from the bank, the title company will distribute the funds, where the majority of the funds will go to the seller's bank or the seller itself if the seller owns the home outright, and the real estate agents will be paid from the portion of the proceeds, as well as other fees that the state and local authorities might have, and the title company, of course, will take their fees as well. After all this, you will receive your keys from your real estate agent, and you will then be able to move into your new home at your convenience. Enjoy your new home, and remember to always make your payments on time in order to maintain a solid credit score. That's my advice on buying a home. Let me know if you have any questions on this or any other topics that you'd like to see me cover. Thanks for watching and have a great day.